Hello everyone. Today we'll be going over accounts, October-November 2021 series, paper 1-2. This is a multiple choice paper and we have a time limit of 1 hour. So let's get started. The first question says that a trader has prepared financial statements which include unpaid wages to her employees. So unpaid wages refers to an expense that has incurred during the year but is yet to be paid. So this is an outstanding expense. Now we need to figure out which accounting concept is being applied. The first option given is business entity. We know that the business entity concept states that the business and its owners are treated as two separately identifiable parties, which is not what is being referred or applied in the question. So option A is incorrect. The second option given is the duality concept, and we know that the duality concept states that every business transaction requires recording of in two different accounts. So it's not something that is being referred or applied in the question. So this is incorrect. The third option given is the matching concept. We know that the matching concept requires that a business records expenses alongside revenues earned. And we know that in the question we're referring to the unpaid wages, which is a type of expenses. It is an outstanding expenses. So the concept being applied here is the matching concept. Let's just look at option D as well. It is a substance over form, and we know that this accounting concept ensures that the financial statements give a complete, relevant, and accurate picture of transactions and events. So this is incorrect as well. So the correct option will be option C. On the second question, we need to figure out on which basis will non-current assets be valued if the business is not a going concern. So going concern concept actually assumes that business will meet its financial obligations when they fall due. Or in simpler terms, it can be understood as a concept which states that business does not have a limited lifetime. But in the question, we're talking about when the business is not a going concern. So it means that the business has a limited lifetime. So during this scenario, on which basis will the non-current assets be valued? So we know that the net book value is recorded in the statement of financial position, and that is when the business is a going concern. So this is not the correct option. The second one is original cost. We know that the non-current assets can never be valued at their original cost since the value always decreases due to various reasons. So that's incorrect as well. The third option is that the amount they could be sold for, which will be the correct one, because we're talking about when the business does have a limited lifetime. So they need to settle their non-current assets, and the settlement could be done by selling them. The last option is the value placed on them by the owner. This cannot be done. So the correct answer will be option C. For the third question, we're given that a business has a financial year end of 31st December and it depreciates its machinery on a month-by-month basis. It means that if the machine is being used for only 6 months, then the depreciation will also be applied for just the 6 months. And we're also given that it uses the straight line method at 10% per annum. It bought a machine, cost 12,000, so this will be our cost. And the machine is being bought on the 1st January 2019 and it is being sold on 31st March 2020. Now, which entries relating to this machine were made in the provision for depreciation of machinery account for the year ended 31st December 2020? So we know that in the provision for depreciation of machinery account, on the credit side, we record the depreciation for the year. So that's going to be on the credit side, which will be the depreciation for the year, for the current year. And we're talking about the year ended 31st December 2020. So depreciation for the year 2020 will be on the credit side. And on the debit side of the provision for depreciation, there's always going to be the entire accumulated depreciation. So accumulated depreciation of assets that is being disposed. And in this case, it's the machinery. So the accumulated depreciation of the machinery will be recorded on the debit side. So firstly, we need to figure out for how many months is the machine being used. So we bought the machine on 1st January 2019 and sold it on 31st March 2020. It means that we use the machine for the entirety of the year 2019, so that's 12 months. And for the year of 2020, it's being used till March, so that's January, February, and March, so 3 months. So in total, we're using the machinery for 15 months. So we can easily figure out the accumulated depreciation. So that's just going to be 20,000 So we can easily figure out the accumulated depreciation of the machinery. So that's just going to be the cost, which is 12,000. We're going to multiply it with the rate, which is 10%. And I'm going to multiply it with the entire 15 months. So that's going to be 15 divided by 12. So this gives us a total of 1,500. And on the credit side, we need to figure out the depreciation for the year 2020. And we know that in the year 2020, we only use the machinery for 3 months. So we just have to figure out the depreciation amount for 3 months. So that's going to be cost 12,000 into rate, which is 10%, into 3 by 12. So that gives us the depreciation for the year 2020 of 300, which is given in the option D. So that's just our answer. A business purchased a non-current asset for 500,000. So this is the cost, with an expected life of 20 years. After that time, it was expected to be sold for 100,000. So this is the scrap value. And it was depreciated using this straight line method. Then the non-current asset was sold after 10 years. This is going to be the sales value. So we're selling the non-current asset for 120,000 with the selling cost of 10,000. And this is the cost. This is the selling cost. All right, we need to figure out the loss on disposal. So we know that the loss on disposal is just going to be the difference between the sales value and the net book value. So let's just figure out the accumulated depreciation for 10 years in order to figure out the net book value. So I'm going to figure out the depreciation per year first. We're given the cost, the expected life, and the scrap value. So I'm going to use the formula of the straight line method, which is cost 500,000 minus scrap value, which is 100,000, divided by the estimated life or expected life, which is 20. So this gives the depreciation per year of 20,000. And then the accumulated depreciation will be of 10 years. So I can just multiply this depreciation per year by 10. So that's going to be 20,000 into 10, which gives us a total of 200,000. Now the net book value is just going to be the cost, which is 500,000, minus the accumulated depreciation, which is 200,000. This gives us a total of 300,000. And we're selling it for 120,000, but we also have a selling cost. So we need to adjust it. So the sales value is actually going to be the sales value given, which is 120,000. But this is a cost. Cost always reduces the money receivable. So I'm just going to deduct this 10,000 from the sales value, which will be received by the business. So this gives the sales value of 110,000. Now, as I said before, the loss on disposal is just going to be the difference between this sales value and this net book value, which is 300,000 minus 110,000. That is just 190,000, which is given in the option D. So in the fifth question, we need to figure out which items are capital expenditure. So the first one given is the payment of wages to staff to install new equipment. So we know that the activity of installing a new equipment is not something that's going to recur every month or in a short span of time. So this is non-recurring expense, which means that this is a capital expenditure. Second one, we have purchase of a new computer for office. So we do not really purchase non-current asset very frequently or in a short span of time, which means that the purchase of an asset is also of non-recurring nature. So the second item is also a capital expenditure. For the third one, we have purchase of spare parts. So spare parts is something that can be purchased very frequently. So this is a recurring activity. And we know that the recurring activities are of revenue expenditure and not of capital expenditure. So this is incorrect. And the fourth one, we have use of factory machinery to repair owner's car. So repairment is something that's going to recur in a short span of time, which means that this is also of revenue expenditure. So only the items 1 and 2 are capital expenditure, which is given by the option A. A sales ledger control account showed a debit balance of 15,000. The following errors were discovered. The first one is of a return outwards 200 had been credited in the sales ledger control account. We know that return outwards is actually purchase returns, and we're talking about sales ledger control account, which means that return outwards should not be on any sides of the sales ledger control account. But since we have credited this return outwards in the sales ledger control account, this is a type of an error. So this needs to be amended. The second one we're given is a contra entry with the purchase ledger control account 400, which had been debited. Again, this is incorrect. While we're talking about sales ledger control account, the contra amount is always credited. So we need to amend this error as well. And the third one we have is a customer balance 300 had been written off in the sales ledger control account, but no entry had been made in the sales ledger. Again, we're talking about the sales ledger control account balance here and not the sales ledger. So this is not an error that should be amended. So we're just going to ignore the item 3. Now let's talk about the errors. So I'm just going to write the error entries first. So we have credited 200. So that's going to be on the credit side. And we have debited the 400. Now I'm going to draw up the corrected balance for debit and credit sides. So we're given a debit balance of 15,000, so I'm just going to enter that first. And what we know is the return outwards had been credited. So this 200 should not have been on the credit side in the first place. And it should not occur in the debit side as well, which means that I'm just going to have to erase this amount. So in order to erase an amount on the credit side, we can just enter that amount on the debit side so that the debit and credit cancel each other out. For the second entry, we have the contra entry, which is on the debit side. But I need this amount of 400 on the credit side. In order to do so, if I put 400 on the credit side once, then the 400 on the debit side and the 400 on the credit side are just going to cancel each other out. So there's not going to be any balance on the credit side as the contra, which means I again need to add another 400 so that even if the first 400 is being cancelled out, the second 400 can act as the contra amount here. Alright, now you just need to figure out the balancing figure over here. So let's total the debit side first, which is going to give us a total of 15,200. And that balance must be the case for the credit side as well. Now, in order to figure out the balancing figure, I'm just going to have to subtract these two values from the total amount. So that's 15,200 minus 400, which gives a value of 14,400, which is in option A. The bank account had a debit balance of 5,760 in the cash book at 31st May. And we're given the items which were identified when reconciling the bank account with the bank statement. Now we need to figure out the actual amount shown in the bank statement at 31st May, which means that we need to adjust these four values. So the opening value is 5,760. And the first item that we're given is the amount not yet credited by the bank. And we know that whenever an amount is added, that's denoted by the debit. And whenever an amount is subtracted, that's denoted by the credit, which means that this value of 900 should have been deducted. So I'm just going to deduct it. The second one is bank charges. Again, it's a type of charge. So obviously this 120 should have been deducted. So I'm going to deduct that as well. The third one is dishonored check, which means that the deposit that should have been come from this value has not yet come, which means that this value should be deducted as well. So I'm just going to deduct the 340. And the final one we have is the unpresented check. Unpresented check always increases the value in the bank account. So I'm going to add this value of 740. Now these gives us a total of 5,140, which is given in option B. That's going to be our answer. A trader maintains a full set of accounting records. Each month, she issues many sales invoices. Where does she record an individual sales invoice? So sales invoice is just the sales bill. So whenever a sale occurs, we need to enter it on the journal first and then on the ledger, which is just given by our option A. That's going to be our answer. Brian had a service business which held no inventory. His current assets and current liabilities at 1st April were as follows. So we're given the trade receivables, we're given trade payables, and the bank overdraft. On that date, he set off a sales ledger balance 600 against a purchase ledger balance. So this just means that the trade receivables and trade payables both should be deducted by this set of amount. So why does this occur is, we know that trade receivables refer to the amount that we are yet to receive, and trade payables refer to the amount that we are yet to pay. So if you have a common person, suppose there's a person A to whom which we owe 600, and then A also owes 600 to us, which means that these balance can just be set off, because if we need to pay 600 to a person A, and if that person A again needs to pay 600 to us, we can pay 0 and he can pay 0 to us. So that's just going to be set off. So I'm just going to deduct the 600 from this and 600 from the payables as well. So this gives us the new value for trade receivables as 9,400, and this gives us a new value for trade payables as 5,500. Then created a provision for doubtful debts of 5%. So we know that this 5% should be multiplied with the actual trade receivables value in order to figure out the provision for doubtful debts. So provision for doubtful debts is just going to be the trade receivables value, which is 9,400, into the rate. So rate we're given is 0.05. So this gives us the provision for doubtful debts of 470. Now, we need to figure out the working capital, and we know that the working capital is figured out by subtracting the current liabilities from current assets. So first I'm going to figure out the value of the current assets. So current assets, among these three values, trade receivables is the only one which is going to come under the heading of current assets, and we know that the trade receivables value is 9,400. But we also need to deduct the provision for doubtful debts amount. So that's going to be 470. So this gives us the value of 8,930. Then we need to figure out the value of the current liabilities. So current liabilities is just going to be the trade payables amount, which is 5,500, plus the bank overdraft. So that's 1,900. So this gives the total value of 7,400. Now we just need to subtract these values. So current assets is 8,930 and the current liabilities is 7,400. So this gives us the total value for the working capital as 1,530, which is given in option C. Frieda's provision for the doubtful debts account for the year included a debit entry representing the change in the amount provided. The rate of provision for doubtful debts has not changed. What might have happened during the year to make this entry necessary? So the debit entry is always gonna be decrement in the value of provision for the doubtful debts. Whenever there's a decrement in the value of provision for doubtful debts, it means that there's a better credit control. So statement 1 is correct, since it states that the credit control procedures had been improved. The second one is automatically incorrect because it cannot be improved and reduced at the same time. And the third one we have is that the total trade receivables had decreased. So what we're given is that the rate of provision for doubtful debts has not changed. It has remained the same, and yet still the value of the provision for doubtful debts has decreased, which means that the total trade receivables should have been increased in order for this to happen. So statement 3 is correct, and statement 4 is automatically incorrect since the value of the trade receivables cannot increase and decrease at the same time. So the only correct statements are 1 and 3, which is given by our option A. A trader's income statement recorded sales of 10,000, cost of sales of 7,070, and the trader had taken goods for his own use during the year, which had cost 280 with a selling price of 410, but had omitted to record this. All right, so before the omission, so I'm just going to list before and after. The sales value will still remain the same, so that's just going to be 10,000 and 10,000. Because drawing does not really affect the sales value. Secondly, we have the cost of sales. Cost of sales. So before the omission, the cost of sales is going to remain 7,070. But if we record this error, we also need to include the drawing that the owner took, which had a cost of 280, which means that the inventory of 280 should be deducted. And we know that the inventory is added in the cost of sales. So if you're deducting 280, so that's just going to be 70 minus 280. So then we can easily figure out the gross profit amount. So before, the gross profit amount was 2,930, and after, the gross profit amount is just going to be 3,210. Now we need to figure out the gross margin. So that's really easy as well. So that's just the gross profit amount divided by sales into 100%. So before, the gross margin will be of 29.3%, and after, it's going to be 3,210 divided by 10,000 into 100%, which gives the gross margin of 32.1%. So the gross margin would have been 32.1%. But due to the omission, it's only 29.3%, which means that this value is understated. But by how much? We just need to figure out the difference. So that's 32.1 minus 29.3, which gives the difference of 2.8%. So the omission has created an effect. So the correct answer is going to be 2.8% understated, which is given by option B. William buys radios for $1.10 each and sells them for $1.15 each. So this is going to be the sales price and this is the cost price. Then his draft statement of financial position included a value of $1,500 for inventory. His method of calculation of inventory was correct. He then found that the 12 radios could only be sold for $1.08 each, and 4 radios had been stolen. All right. So when we're valuing the inventory, we're going to include it in the cost price. So cost price is $1.10. But we're given that out of the total units included in the inventory, 12 radios could only be sold for $8, which means that the value has decreased. So net realizable value is less than that of the cost price. So the difference in the value is $2, which means that $2 should now be reduced from all the 12 radios. So that's just going to be 2 into 12. And then 4 radios had been stolen. So if it's stolen, its net realizable value will go to 0, which means that the difference now is 10. So that's $10 into 4. And we need to figure out by how much should William reduce. So this is just the reduction amount. So reduction is given by $2 for the 12 radios, which could only be sold for $8, because the difference between the cost price and the net realizable value is of $2. And for the 4 radios that had been stolen, the difference between the value of the cost price and the net realizable value is $10. We're just multiplying those differences to the number of units, which is $2 into 12 plus $10 into 4, which gives us the total reduction value of $64. That's in option A. A sole trader has not kept a full set of double entry records, and we're given the following information which relates to the business for the year ended 31st March 2021. So we're given the sales, inventory, closing inventory and opening inventory, and then we're also given the prepaid expense and the expenses paid by check. What we're also given is that all goods are marked up by 25%. So we need to figure out the value of the purchases and the profit for the year. So if the goods are marked up by 25%, it just means that the sales value is 1.25 times the cost of sales. So sales value is already given over here. So that's 210,000 equals to 1.25. We need to figure out the cost of sales. So this is quite an easy equation. So this is just going to be 210,000 divided by 1.25, which gives the value of cost of sales as 168,000. Now, in order to figure out the purchase, we know the formula for cost of sales to be opening inventory plus purchase minus closing inventory. So we already figured out the value for cost of sales, which is 168,000. The value for opening inventory is 17,600. We need to figure out the value of purchase. And we're also given the value of closing inventory, that's 18,700. So the value for purchase is going to be 168,000 minus 17,600 plus 18,700. This means that the total purchases value is of 169,100. Now we also need to figure out the profit for the year. So let's just figure out the gross profit first, which is given by the sales value minus the cost of sales. This gives the gross profit of 42,000. And in order to figure out the profit for the year, we need to adjust these expenses. So we know that the expenses should be deducted, but we also need to adjust this expense since we're given the prepaid expense at 1st April. So this is an opening prepaid expense. And we know that the opening prepaid expenses are always added to the expenses paid. So the total expenses is just going to be, I'm just going to write it here, 630 plus 11,900, which gives the value of 12,530. So that's the expense we need to deduct from the gross profit. After the deduction, we get the value for profit as 29,470. So the purchase value of 169,100 and the profit value of 29,470 is given in option D. That will be our answer. We need to figure out which statement is correct in the absence of a partnership agreement. The first one is that interest is charged on drawings at 5%. This is wrong. The interest on loan is actually charged at 5%. So option A is incorrect. Second one is that only one partner can have salary. So when there is no partnership agreement, none of the partners can have any salary. So this is incorrect. The third one is that partners are not entitled to interest on capital. This is a correct statement. And the fourth one is that the profits and losses are shared in the ratio of partners' capital contribution. This is incorrect since the profits and losses are shared equally in the absence of partnership agreement, which means that our correct answer is going to be option C. X and Y are in partnership, sharing profits and losses equally. They have combined capital account balances of 200,000. Then Z was admitted as a partner and non-current assets were revalued upwards, which means that the profit on revaluation will be 30,000. And then the goodwill was valued at 20,000 but was not to be retained in the books of account. Following Z's admission, the total of the partner's capital. So this is the total of all three partners, this is X, Y, and Z. So the total is also given as 270,000. We need to figure out how much capital did Z contribute. So I'm just going to draw up the capital account, but I'm going to include all three of the partners' balances. So that's going to be X plus Y plus Z, X plus Y plus Z. So the opening balance for X and Y is going to be 200,000. Then Z must have contributed some value. So I'm just going to denote that with a Z now. Then we're given that the non-current assets were revalued upwards. So we know that the profit on revaluation is always recorded on the credit side. Then we're given the goodwill. So goodwill old ratio is going to be on the credit side, while the goodwill new ratio is going to be on the debit side. Then we're given that the total of the partner's capitals account was 270,000, which will be given on the debit side. So let's just total up the debit side first. So that's going to be 20,000 plus 270,000, which gives a total of 290,000, which must be true for the credit side as well. Now Z here is going to be the balancing figure. So in order to figure out the value for Z, we need to subtract these 200,000, 30,000 and 20,000 from the total balance of 290,000. So while doing so, we receive the value for Z as 40,000. So 40,000 is the amount of capital that Z contributed, which is given in option B. A company's statement of financial position at 1st January 2020 included the following amounts. We're given the ordinary shares, general reserve, and retained earnings. And we're given 3 events. So the company issued a further 50,000 ordinary shares at a premium. So the total premium is going to be 50,000. That's the number of shares into premium value, which is 1. So this is just going to be 50,000. Then the company's land was revalued upwards by 130,000. So this is the revaluation reserve. And the third one we have is that the company paid a final dividend of 60,000. So we need to figure out the total revenue reserves and the total capital reserves at 31st December 2020 after these 3 transactions. So we know that ordinary shares are not included in both the revenue reserves and capital reserves, so we can completely ignore this. Next, what we know is that the capital reserves include premium and the reserves arising from non-current assets, so which means that the revaluation reserve will also be included over here. So we already figured out the value for the premium, which is 50,000, and the revaluation, which is 130,000, which gives us the total capital reserve of 180,000. Then for revenue reserves, it's going to be the retained earnings and the general reserve. But we also need to adjust the dividend, since dividends are deducted from the retained earnings. So this is just going to be 120,000 minus 60,000 plus 80,000. So this gives us a total of 140,000. So the total revenue reserves is 140,000 and the total capital reserves is 180,000. This is given in option A. A company revalued its premises upwards. Which statement about the increase in value is correct? The first one is that it is an unrealized profit. This is absolutely true. So whenever any premises or any non-current assets is revalued upwards, it is because there is an involvement of an unrealized profit. The second option is that it is debited to the revaluation reserve. So whenever there is a revaluation downwards, that's an expense. And we know that the expenses are always debited. But we're talking about revaluation upwards, which means that it's an income. And incomes are always credited. So option B is incorrect. The third one is that it is recorded in the income statement. So revaluation amount is never recorded in the income statement. So that's just false. And the final one is that it can be used to pay cash dividends. This is incorrect as well. Dividends can only be paid from retained earnings or other reserves, not the revaluation reserves. We can pay it from other revenue reserves, but not the capital reserves. So the correct answer over here is option A. The table shows equity and liabilities of a company at 31st December 2020. So we need to figure out the total of non-current liabilities in the statement of financial position at 31st December 2020. Okay, so we're given the ordinary share capital, So this is not included in the non-current liabilities since ordinary share capital is the shareholders' equity, 6% debentures. So this is included in the non-current liabilities since we have to pay it by the year 2030, and currently it's the year 2020, which means that this is repayable after a term of 1 year. So that's long term. So that's going to be included in the non-current liabilities. Third, we have bank loan, which is repayable on 2024. Again, that's 4 years difference. That's 5 years difference. Third one we have is bank loan repayable on 2024. So that's a 4-year difference, which means that this amount can also be repaid in a time which is longer than 1 year. So this is long term. That's why this is going to be included in the non-current liability section. Third one we have is the bank overdraft. We know that bank overdraft is a current liability, so that's not going to be included. And the final one we have is mortgage on buildings, which is repayable on 2021. So the current year is 2020, which means that this mortgage should be paid within a year. So that's not going to be included in the non-current liabilities. So the total of these two, that's going to be 150,000 plus 75,000. Now this amount should be the total amount, which is given by 225,000, which is in option B. The non-current asset turnover of a business improved between 2020 and 2021, even though the net revenue was the same for both years. So we know that the non-current assets turnover is given by the formula revenue divided by the non-current assets. And what we're also given is that the revenue was same for the both years. So revenue has not changed at all. And we're given that there is an improvement in ratio, which means that the ratio should be higher than last year. And in order for the ratio to be higher, if the revenue is constant, then the net current assets value should be lower than that of last year. So we're just going to look for that in these options. The first one is that a reduction in the level of irrecoverable debts. So irrecoverable debts is not related to non-current assets at all. So this option is incorrect. The second one is an upwards revaluation of the premises at the year end. So whenever there's an upward revaluation of any non-current assets, the value of the non-current assets is going to increase. But we're looking for something that's going to decrease the value of the non-current assets, which means that the option B is incorrect. The third one we have is depreciation charged being higher than the cost of the new non-current assets. If the depreciation charge is higher than new purchases, then the total value of the non-current assets will decrease, which is what we're looking for, which means that option C is correct. Option D states that the purchases of new non-current assets being greater than disposals. So whenever the purchase is greater than disposals, the value of the non-current assets is going to increase, which is the opposite of what we're looking for, which means that option D is incorrect as well. So the correct option will be option C. A business provides the following information. We're given the trade payables, opening inventory, closing inventory, credit purchases, and credit sales. And we need to figure out the value of the trade payables turnover, which is given by the formula of trade payables divided by credit purchases into number of days, which is 365. So we're given the value of trade payables along with the value of credit purchase. So we can just easily figure this one out. So the trade payables is going to be 39,540. Divided by credit purchases, which is 184,600 into 365. So this gives a value of 78.18, which can be rounded off to 79 days, given by option C. So when a company produces 5,000 units of a product, it requires one supervisor. And if the production is increased beyond 5,000 units, then 2 supervisors are required. Which type of cost is this an example of? So it cannot be fixed cost since it is increasing beyond 5,000 units. The second one is semi-variable. So this cannot be actually categorized as semi-variable, so that's incorrect as well. The third one is stepped cost. We can see that after a certain range of production, the cost increases. So here this certain range is of 5,000 units. So the cost is just going to increase, which is going to create a step. So that's stepped cost. So the correct answer is going to be option C. A business employs 20 workers as production staff, and each worker is employed 40 hours per week at a rate of 7.80 per hour. So that's the normal rate. Nextly, the bonus is calculated at 20% of basic rate. So I'm just going to calculate the bonus amount. So the basic rate is 7.80 and the bonus is going to be 20% of this. So I'm just going to multiply it with 0.20, which gives the bonus rate of 1.56. And this bonus rate is given for each product manufactured above 120 units per employee. And in a week, each employee produced 145 units, which means that the extra units is of 145 minus 120. So the bonus is eligible for 25 units for each of the employees, and we need to figure out the total wages. So in order to do so, I'm just going to figure out the wages per employee first. So the employee worked 40 hours. So that's just going to be 40 into the normal rate, which is 7.80. And every employee has produced an extra unit of 25. So that is eligible for a bonus of 1.56. So this gives the total wages per employee as 351. But we need to figure out the total wages for all the employees. So that's 20 employees. So I'm just going to figure that by multiplying 20 with the wages per employee. So that's 351. So the total wages for the week is 7,020, given by option A. A business uses absorption costing to set its selling prices. Which overheads are accounted for by the use of overhead absorption rate? So whenever an absorption costing is used, we know that only the cost relating to the production is accounted for, which is given by option B. A business uses absorption costing and applies a markup of 50% when setting selling prices. So each unit of product acts as a direct cost of 60 and the selling price of 150. So we're given the selling price, and we also know that the markup is of 50%. So I'm just going to figure out the total cost. So total cost into 1.50 is going to be the selling price. So that's total cost equals to the selling price is 150 divided by 1.50, which gives us the total cost of 100. And out of this 100, we know that 60 is a direct cost. So that's related to the manufacture or production of the goods, which means that the remaining 40 is related to the overhead. And we need to figure out the overhead absorption per machine hour. So we know that the overhead is of $40, and each requires 2 hours of machine time. So the overhead absorption rate is just going to be the overhead, which is 40, divided by the machine time, which is 2. That gives us the rate of 20, which is given in option C. A business had no opening inventory. In 1 month, it produced 4,000 units and sold 3,500 units. And we're given the following information of the selling price, variable cost, and fixed cost. How would inventory value and profit vary between absorption costing and marginal costing? So this will be the absorption costing. This is the marginal costing. So let's just figure out the value for inventory first. So we know that out of 4,000 units, 3,500 units were sold, which means that the remaining units are of 500. And in absorption costing, we know that the total cost, which is the variable cost and fixed cost, is included for inventory valuation. So that's just going to be 30 plus 15 into the number of units, which is 500, which gives us the total inventory valuation of 22,500 in absorption costing. But in the marginal costing, we know that we only include the variable cost while valuing inventory. So that's going to be 30 into 500, which gives the marginal inventory valuation of 15,000. Now we can see that absorption costing is clearly greater than marginal costing by I'm just going to deduct that. So 22,500 minus 15,000, which is 7,500. So absorption costing gives a greater value for inventory than the marginal costing by 7,500, which is given in our option A and B. Now we need to figure out the profit. So we know that whether it be absorption costing or marginal costing, the cost of goods produced is going to be the same. So we're going to include both the variable cost and fixed cost. So that's going to be 30 plus 15 into 4,000. So this is just 45 into 4,000. So that's going to be 180,000. And the selling price is 70. And we also know that the number of goods we sold is 3,500. So the sales price, so this is the total cost and this is the sales. So sales price is going to be 70 into 3,500 for both of the marginal costing as well as the absorption costing. Which gives us the total value of sales as 245,000. All right, now we're talking about profit. So in order to figure the profit out, we need to adjust the value of inventory as well. So for absorption costing, in order to figure out the profit, I'm going to write the sales value first, which is 245,000. I'm going to deduct the total cost then, which is of 180,000. But the inventory value should be added in order to figure out the profit. So I'm just going to add the 22,500, which gives the total value of 87,500. So that's the profit for absorption. Now we need to figure out the same for marginal as well. So the sales value for marginal is the same. So is the total cost. But the inventory value differs. So that's just 15,000. Which gives us the total profit for the marginal costing as 80,000. Again, the difference between the profit with absorption costing and marginal costing is 75,000. And again, the absorption costing is producing a higher value of profit by 7,500, which is given by option A. So the correct answer will be option A as well. Which costs are a part of the marginal cost of a product? So marginal cost includes all the direct materials and the variable cost. So that's given by 1 and 4, which is our answer B. A company provided the following information. So we're given the variable cost, we're given the contribution, fixed production cost, along with the fixed selling and distribution cost, and we need to figure out the break-even sales revenue. So this is just given by the fixed cost divided by contribution to sales ratio. So in order to figure out the contribution to sales ratio, we need to figure out the value of the sales first. And we know that the sales value is given by variable cost plus contribution. So that's going to be 540,000 plus 360,000, which gives a total of 900,000. Now the fixed costs are going to be the fixed production cost and the fixed selling and distribution cost. So that's 100,000 plus 320,000, which is 420,000. Then the contribution to sales ratio is given by the contribution value of 360,000 divided by the sales value of 900,000 into 100%. Which gives the value of 40%. Now we just have to compute the fixed cost divided by contribution to sales. The fixed cost is 420,000 and the contribution to sales ratio is 40%, so that's just 40 by 100. So this gives the total budgeted break-even sales revenue as 1,050,000, which is given in the option D. Now, details for two products made by a company are given below. So we're given the selling price and variable cost for both product X and product Y. And the company could sell a maximum of 11,000 units of X and 9,000 units of Y. However, the company cannot produce more than 1,000 units of X and Y together due to the production constraints. Now, which production mix will maximize the profit? So I'm just going to figure out the individual profit first. So for product X, the profit is going to be 13 minus 11, which is 2. And the profit for product Y is 8 minus 4, which is 4. So if we're producing 10,000 units of X and 0 units of Y, that's going to give us a profit of 10,000 into 2 plus 0 into 4, which is 20,000. And if we're producing 1,000 units of X, that's 1,000 into 2. And if we're producing 9,000 units of Y, that's 9,000 into 4, which gives us a profit of 38,000. And if we're producing 9,000 units of X and 1,000 units of Y, that's going to give us a profit of 22,000. And for the last option, we're producing 5,000 units of X and 5,000 units of Y. So that gives us the total profit of 30,000. So among these four, the highest profit is produced by the second option. So that's going to be our correct answer. A manufacturer has a target profit of 80,000 per annum, and last year the business made a profit of 60,000 when 10,000 units were produced and sold, and the contribution was $10 per unit. So I'm just going to figure out the fixed cost over here first. So that's given by the number of units, which is 10,000, into contribution per unit, which is 10 minus fixed cost, equals to the profit, which is 60,000. So here the fixed cost is going to be 10,000 into 10 minus 60,000, which is 40,000. Alright, now in order to achieve the target profit, the plan is to increase advertising by 10,000 per annum. So we know that advertising is a type of fixed cost. So fixed cost is being increased now. So now the fixed cost is going to be the previous fixed cost of 40,000 plus the new addition, which is of 10,000, which gives the total value of 50,000. And the variable cost per unit and selling price per unit will remain unchanged. So what will be the total fixed cost? So the total fixed cost is just going to be this 50,000, which is given in option D. For the last question, we need to figure out the advantages of a budgetary control system. The first statement states that the budgets help to prepare year-end financial statements. This is absolutely false. Budgets cannot really help anything in determining the year-end financial statements since it cannot predict the future. The second statement states that the budget may be set at easily achievable levels to make sure the business appear more efficient. So that's incorrect. Budgets should not be deceiving like this. The third statement states that the managers become responsible for implementing their department's budget, which is true. And the fourth one is that where budget targets are not met, corrective action is taken, which is true. Since the budget targets are not met, it means that some aspect of the business must be lacking, which need to be improved, in which the corrective action is taken. So the correct statements are statements 3 and 4, which is given by option D. So that's the end of this set. If you found this video useful, please leave a like, leave a comment, and make sure to subscribe in order to view more of these contents in the future. Thank you.